All right, let's jump right in. Today, we are cracking the code on something called international transfer pricing. It sounds complicated, but stick with me. We're going to see how one simple decision, how a company prices a product it sells to itself, can literally shift millions in profit around the globe and dramatically change its tax bill. Let's get into it.
So, what are we talking about here? At its heart, transfer pricing is just the price that one part of a big global company charges another part in a different country. Think of it like an internal sale. But this isn't just some boring accounting entry. Oh no, it's a massive strategic tool that dictates where profits are officially made and, here's the key, where taxes get paid. Let's put you in the CEO's chair for a second. Imagine you've got a factory in India making amazing products, and you own a store in France that sells them. How much do you have your French store pay your Indian factory? Is it the cost, the market price, something in between? This single question is the puzzle global companies have to solve every single day, and the answer has huge financial consequences.
So, here's our game plan for today. We're going to walk through a really cool case study about a company called QuickLink. First, we'll lay out their pricing puzzle. Then, we'll run two different scenarios, one pricing at cost and one pricing at market value. Finally, we'll put them side by side to figure out the absolute most profitable path for the company as a whole.
Okay, so first up, let's get to know our company, QuickLink. They're in a classic situation. They build mobile phones in their plant in India, and then they sell them through their very own marketing division over in France. And this is where their big transfer pricing challenge begins.
Here are the vitals you need to know. QuickLink is moving 50,000 phones a year between these two divisions. Now, pay super close attention to these numbers, because this is where the magic happens. The tax rate in India is 35%. In France, it's higher, at 40%. But here's the real game changer. France also slaps a 15% import duty on the phones, and, this is critical, that duty is based on the transfer price. That duty is a real, out-of-pocket cost. These three percentages, they are the keys to unlocking this whole puzzle.
So let's just nail down this core concept. The transfer price is simply the internal price for the sale across borders. Now think about it. A higher price means more profit gets booked in the selling country, which is India, and higher costs get booked in the buying country, France. The ultimate goal here is to find a price that is perfectly legal but minimizes the company's total global tax and duty bill.
All right, let's dive into our first scenario. We're going to see what happens when QuickLink uses the lowest possible price that tax authorities will allow them to, which is the full cost of manufacturing the product.
So, for this first run-through, we're setting the transfer price at exactly 12,000 rupees per phone. This isn't a random number, it's the full cost to make one unit. No profit margin built in, just pure cost.
Okay, let's walk through the math for the Indian division. It's pretty straightforward. The basic formula is always profit equals revenue minus costs. So their revenue is the transfer price they receive, which is 12,000 rupees. Their cost to make the phone is, well, it's also 12,000 rupees. So their profit before tax is zero. And of course, 35% tax on zero is zero. The result? For the Indian division, the profit after tax is a big fat zero. Easy enough.
Now, let's flip over to the French side and see how they're doing. They sell the phone to the final customer for 18,000 rupees. Their main cost for that phone is what they paid the Indian division, the transfer price of 12,000. But wait, here comes that all-important extra cost, the 15% import duty. And that's calculated on the transfer price, so 15% of 12,000 adds another 1,800 rupees to their cost base. This leaves them with a pre-tax profit of 4,200. We apply the 40% French tax rate, and the final after-tax profit in France comes out to 2,520 rupees per phone.
Okay, so that was scenario one, pricing at the bare minimum. Now, what happens if QuickLink does the exact opposite? What if they use the highest price the law allows, which is what the phone would sell for on the open market?
In this second scenario, the transfer price gets a big bump up to 15,000 rupees per unit. This number represents what an independent, unrelated company would charge for a similar phone. It's a really important benchmark that tax authorities look for, known as the comparable market price.
Let's run the Indian numbers again, but with this new higher price. Their revenue is now 15,000 rupees, while the manufacturing cost hasn't changed. It's still 12,000. So this time, the Indian division actually shows a pre-tax profit of 3,000 rupees per phone. After we apply that 35% Indian tax rate, their after-tax profit is 1,950 rupees. So you see, by raising the internal price, they've successfully shifted taxable profit into India.
But what's the knock-on effect in France? Well, their cost of goods just shot up to 15,000. And that nasty import duty? It's now 15% of this higher price. So that cost becomes 2,250 rupees. This seriously squeezes their profit margin, leaving them with just 750 rupees of pre-tax profit and a tiny final after-tax profit of only 450 rupees per phone.
All right, the moment of truth. We've got two very different outcomes. In one scenario, basically all the profit is made in France. In the other, it's split between both countries. But the big question is, which path is actually better for Quicklink as a single unified company? Let's find out.
And this slide just lays it all out, plain and simple. Let's add up the after-tax profits from both divisions in each scenario. With the low-price method, you have 0 from India plus 2520 from France, for a total company profit of 2520 per unit. With the high-price method, you have 1950 from India plus 450 from France, which only adds up to 2400 per unit. The picture is crystal clear.
So the winning strategy, without a doubt, is to price at the minimum full manufacturing cost. Now, that small difference per unit might not seem like much, but when you multiply it by 50,000 phones, we're talking about a difference of 6 million rupees, or 60 lakhs, in profit every single year. Pricing low is clearly the most profitable path.
But wait a minute, why is the lower price better? It feels a little counterintuitive, right? You'd think shifting profits out of high-tax France would be the smart move. To really get to the bottom of this, let's do a little experiment. Let's zoom way in and see what happens if we increase the price by just 1 single rupee.
Let's follow the rupee on its journey. If the price goes up by 1 rupee, India's profit goes up by 1 rupee, and their tax bill goes up by 35 paise. Simple. Now, over in France, their costs increase by 1 rupee and 15 paise. That's the 1 rupee price increase plus the 15 paise of extra import duty it triggered. Now, because their costs are higher, their taxable income is lower, so their tax bill actually goes down by 46 paise. But here's the catch. The 46 paise they save in French taxes is not enough to cover the 35 paise extra tax in India, plus the 15 paise in extra duties. The company is worse off.
And here it is, the magic number. For every single rupee that Quicklink increases its transfer price, its total global after-tax profit decreases by 4 paise. That is the hidden penalty created by that import duty interacting with the different tax rates. It's a tiny number that adds up to millions.
So what this case really shows us is the fundamental logic of transfer pricing. The optimal strategy is always to legally shift profits to the location with the lowest overall tax and duty burden. In this case, that 15% import duty was the tipping point. It made France the high-burden country. So keeping the price low minimized the profit there and maximized Quicklink's total income.
All right, for everyone studying for exams, let's lock this in with a quick formula flash recap. Profit before tax is always revenue minus costs. Profit after tax is just your profit before tax minus the tax you pay on it. But the absolutely critical formulas for this case were these two. The French cost of goods is the transfer price plus the import duty, and that import duty itself is calculated as 15% of the transfer price. You nail that relationship, you solve the puzzle every time.
And let's end on a classic management dilemma. Let's say you were the manager of the Indian division, and your annual bonus was based only on your division's profitability. Which price would you argue for? You'd fight tooth and nail for that higher price of 15,000 rupees because it makes your division's numbers look fantastic. But as we just proved, that exact decision would actually cost the entire company millions. And resolving that conflict, what's best for a single division versus what's best for the corporation, is one of the toughest real-world challenges in all of finance. What a fascinating puzzle. Thanks for joining me on this one.